Hey everyone, welcome back to the channel. Today, we're diving deep into WarnerBros.Discovery, ticker WBD, a major player in the media and entertainment space. There's a lot to unpack here, from their latest financials to the ongoing acquisition drama, so grab a coffee and let's break it all down together. Alright, before we get into the numbers, let's set the stage. WarnerBros.Discovery has been making headlines lately, not just for their content, but for the intense bidding war surrounding the company. With names like Netflix and Paramount in the mix, the future of Hollywood itself seems to be at stake. We'll get into that, plus a full analysis of their financial health, valuation, and where the stock might be headed. If you're an investor trying to figure out if WBD is a buy, hold, or sell, stick with me. This is going to be a comprehensive look at everything you need to know. So, who is WarnerBros.Discovery? If you're not super familiar, WBD is a global media and entertainment giant headquartered in New York. They operate through three main segments: studios, network, and direct-to-consumer, or DTC. Think iconic brands like Warner Bros. Pictures, HBO, CNN, and their streaming platform Max. They've got a massive content library, everything from blockbuster movies to hit TV series, and they reach audiences worldwide with over 35,000 employees driving the business. Led by CEO David Zaslav, WBD is a powerhouse in the communication services sector, specifically in the entertainment industry. Their mission? To deliver premium content across multiple platforms, whether it's in theaters, on cable, or streaming directly to your device. Let's talk money, specifically revenue. For fiscal year 2024, WBD reported total revenue of about $39.3 billion. Breaking it down by segment, distribution revenue was the biggest contributor at roughly $19.7 billion, which includes subscription fees from cable and streaming services. Content licensing contracts brought in another $10.3 billion, showcasing their strength in licensing shows and movies to other platforms. Advertising revenue clocked in at $8.1 billion, though that's an area facing headwinds with the decline of linear TV. Geographically, the United States dominates their revenue at $26.4 billion, while non-U.S. markets accounted for $12.9 billion, showing they've got a solid global footprint but still rely heavily on the domestic market. What stands out here is their pivot towards streaming and content licensing as traditional advertising weakens, something to keep an eye on as the industry evolves. Now let's dig into their earnings. In their Q4 2024 results, Warner Bros. Discovery posted a loss, missing analyst estimates, with revenues down 6% year-over-year. For the full year, they reported a staggering net loss of $11 billion, translating to an EPS of negative $4.62. Compare that to 2025, where they turned things around with a net income of $2.5 billion and an EPS of 29 cents. What's behind these wild swings? A lot of it ties to operating losses in prior years, including a $10 billion operating loss in 2024, driven by restructuring costs and challenges in their linear TV and studios segments. On the bright side, streaming subscribers are growing, which is a key driver for future profitability. The takeaway? WBD is in a transition phase, cutting losses in traditional media while betting big on direct-to-consumer growth. Diving deeper into their Q4 2024 earnings call, management highlighted a few critical points. They ended the year with strong growth in their global direct-to-consumer subscribers for Max and Discovery Plus, signaling that their streaming strategy is gaining traction. They also emphasized operational improvements like reducing content spend while still delivering popular programming. Debt reduction was another focus. Management is working to strengthen the balance sheet, which is crucial given the high leverage we'll discuss shortly. They're optimistic about 2025, expecting streaming to drive adjusted EBITDA growth and improved free cash flow. The message here is clear. WBD sees itself as a leader in the streaming wars, even if the path to consistent profitability is still a work in progress. Let's get into the nitty-gritty of their financial statements. On the income statement side, revenue has been fluctuating, down from $41.3 billion in 2023 to $39.3 billion in 2024, before dipping to $37.3 billion in 2025. Gross profit margins are decent at around 44%, but net profit margins are razor-thin at just 1.3% in 2025, reflecting heavy costs and debt servicing. Speaking of debt, their balance sheet shows total liabilities of $62.9 billion against total assets of $100 billion as of 2025. That's a debt-to-equity ratio of 0.94, which isn't catastrophic, but definitely signals they're carrying a heavy load. Cash flow is a brighter spot. Free cash flow for 2025 was $3.1 billion, down from $4.4 billion in 2024, but still strong enough to support operations and debt repayment. Current ratio sits at 1.07, so they've got just enough liquidity to cover short-term obligations. Overall, the financials paint a picture of a company with potential but burdened by past mergers and high debt. So what's WBD worth? Let's look at valuation. Right now, the stock is trading at $28.70 with a market cap of about $69.9 billion. Their trailing PE ratio is sky high at 146.95, largely because earnings are so inconsistent. Price-to-sales ratio is more reasonable at 1.88, suggesting the market isn't overvaluing revenue generation. Looking forward, analyst estimates for 2025 peg the forward PE at 92.9, still elevated, but reflecting expectations of earnings recovery. Enterprise value is $101 billion, factoring in their debt load. Compared to the entertainment industry average PE of 124.5, WBD looks expensive, but that's partly due to depressed earnings rather than an inflated price. My take? The valuation hinges on whether they can turn streaming growth into consistent profits. If they do, this could look cheap in a few years. If not, the high multiples are a red flag. Let's break down Warner Bros. Discovery through a SWOT lens: strengths, weaknesses, opportunities, and threats. Starting with strengths, WBD has a killer content portfolio. We're talking HBO, Warner Bros. Films, and a growing streaming platform in Max. Their global reach is another plus, with a presence in multiple markets. Weaknesses? High debt levels are a big one. Nearly $63 billion in liabilities weighs on their flexibility. Linear TV is also dragging, with ad revenue declining as cord-cutting accelerates. On the opportunities front, streaming is their golden ticket. Subscriber growth for Max is strong, and expanding into new markets could unlock more revenue. They've also got potential in content licensing deals. Threats include fierce competition. Netflix, Disney+, and Amazon aren't slowing down. Plus, economic downturns could hit discretionary spending on entertainment. The ongoing acquisition uncertainty doesn't help either, as it could distract management. Bottom line, WBD has the assets to succeed, but execution and debt management are critical. Now let's check out WBD's recent performance on the charts. Over the past week, the stock is up 2.42%, and over the last month it's gained 1.81%. Zoom out to 3 months, and you've got a 25.66% jump, while 6 months show an incredible 149.13% surge. Over 1 year, it's up 160.42%, though the 5-year return is a painful negative 48%. Clearly, WBD has been on a tear lately, likely fueled by acquisition rumors and streaming optimism. But that long-term loss reminds us of the volatility here. Looking at short-term moves, momentum is strong, but I'd watch for overbought signals. RSI might be creeping up. If you're trading, a pullback could offer a better entry. For long-term investors, this chart shows recovery potential, but also risk if the rally fizzles. All right, let's wrap up the numbers with an intrinsic value analysis. I've run the numbers using a discounted cash flow model, factoring in their free cash flow trends, growth projections for streaming, and current debt levels. I've assumed a conservative growth rate of 5% for the next 5 years, tapering down, and a discount rate of 8% to account for industry risk and their leverage. Based on my calculations, WBD's intrinsic value comes out to around $32 per share, compared to the current price of $28.07. That suggests the stock might be slightly undervalued, offering a potential upside of about 13%. Keep in mind, this hinges on them hitting streaming targets and managing debt effectively. If those don't pan out, the downside risk is real. So, while the numbers lean toward a buy, it's not a slam dunk, more of a cautious opportunity for patient investors. MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our Stock's Intrinsic Value Calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.